Hey, what's going on? It's Lewis here with Crypto Leads, and in today's video, we're going to be going over moving averages. Moving averages are technical indicators that you could use to help you determine whether or not it's a good time to get into or out of a trade. And this can help you to buy cryptocurrencies, sell cryptocurrencies, and make profits. So we're going to be going over a few different types of moving averages in this video. We're going to be going over simple moving averages, exponential moving averages, and basically how to use them. So I decided to make a presentation for you to go over all of this. It's a little bit long, but moving averages are very important when it comes to trading and cryptocurrencies and stocks and forex and everything like that. So it's well worth it. So with saying that, I will see you in the presentation. Alright, so in today's technical analysis video, we're going to be going over the moving average. The moving average is one of the most commonly used technical indicators. The thing about moving averages is that they're sort of like a self-fulfilling prophecy in that so many people use them that they help to dictate the market because so many people put their orders in based off of the moving averages. Now, before I get into anything in this video, just like all of my other videos, this is not financial advice. I'm not a financial advisor, and you should always consult with a professional financial advisor before making any decisions with your finances. Investing and trading is risky, so definitely know that. So now that that's out of the way, let's get on to some use cases of the moving average. There are a lot of use cases for the moving average. It could be used as support and resistance levels. It could be used to see if the coin is reversing from an uptrend to a downtrend or vice versa. It could help you with your setups of making good buying and selling positions, and it could help you to determine where to place your stop losses. Keep in mind though that this is just like any other indicator and that you should use a multitude of many different indicators in order for you to be very confident in your decision. There's no one perfect indicator out there. A good strategy is to have at least 3 different indicators telling you or confirming you that the trade is good before you pull the trigger. So with saying that, let's get into what the moving average is. The moving average is exactly what it sounds like, and it's what the name implies it is. It's the average of the moving price of a coin. And that simply means that you take 0.1 plus 0.2 plus 0.3 plus however many points that you want, and then you divide it by however many points there are, and that's the average. So I put it right here, A plus B plus C plus whatever divided by n, where n equals the number of values that you used in your equation. And now n could be really whatever you want. So n could be a period of 9 or 10 or 20 or 21 or 50, 55, 100, 200. So for an example, the 10-day moving average would be the average closing price for the last 10 days. Or it would be the closing price for the last 10 days added up and then divided by 10. And you could also use this on the hourly and on the minute chart. It doesn't really matter it does matter what time chart you use it on, but you can use it on any time chart and it will adjust automatically when you use it on the different time frames. Whether you use the daily, the weekly, the hourly, the minute chart, those things are called periods. Those time periods are called periods, and periods are simply short for time periods. So that's what I mean and that's what people mean when they say, what period are you using? Are you using the 1 hour chart, the 1 day chart, stuff like that. So if you have your moving average on the hourly chart, and let's say you have the 10 period moving average on the hourly chart, that will take into account the average price of the last 10 hours. If you have the moving average 10 period open and it's on the daily chart, then that means that it takes the average of the last 10 days. And usually you don't use the daily chart with the hourly chart, but a lot of times people, they mistakenly say, they'll have the hourly chart put up and they'll say, oh, I'm using the 10-day moving average on the hourly chart. That's not really technically correct, so be aware of that. Also keep in mind that you have to have sufficient data in place for the coin in order for the moving average to actually show up. So what that means is that if you have a coin and it's only 30 days old, you can't really glean any information from the 200-day moving average because there hasn't been 200 days for the average to be calculated. So sometimes if you go to plot the 200-day moving average for some of the newer coins that haven't been out for that long, it might not show up, and that would be the reason why. There's simply not enough data. Now, I'm gonna head over to Coinigy, which is the software that I use for technical analysis, and I'll show you what I mean. Okay, so this is Coinigy, and this is the software that I use. So I'm gonna take myself off the screen now, just in case I need this area down here or wherever my head is right now. Okay, now whether you're using this software or Coinigy, or you're using TradingView, which is an even more popular thing, then what you need to do is you need to go to your Indicators tab, which is right up here, and you need to plot out your moving average. So all that you need to do is open that up and then type in moving average, and it'll come up. You could also, if you don't want to type in moving average, you could also type in MA, and MA moving average will show up. Then you just click that button, and you'll see that this line came on the screen after I clicked the button. So let's just explain this again. So the last price of the moving average, the MA, which is what it's called, is the average of the X number of periods. So right now I have the 1 hour chart, and I'm actually gonna change that over to the 1 day chart because I like using the 1 day chart. And what you could see if we zoom in a little bit is the moving average, and that is designated by this MA right here, and it has MA 50 close 0. So let's take a look at what all of this means. Well, the length for this particular MA is 50, so it's 50 periods, and I'm on the daily chart, so it's the moving average, the 50-day moving average. And you know what, we're actually gonna make this a little bit thicker so that you could see it a little bit better. And what we'll do is we will change it to yellow. How about that? So now we have the 50-day moving average up on the screen. And so what that means is that it takes the last 50 closing prices. So from here, and this is the 15th, so all the way back to around here, and it takes the closing price. So you could see the MA close right here. So it takes the closing price, which is on the red candlestick, the bottom part of the red candlesticks, and it's the top part of the green candlesticks, and it adds them all together, and then it divides it by 50 in this case, and that is this point right here. So if it was a 10-day moving average, then it would just be the last closing prices of the last 10 days, which would be, you know, somewhere, it would be like right here. So it would be the last closing prices of these, and then that would be what this is right here. And now this is a moving average, right? So let's say that you plotted the moving average right here for the 10-day moving average. What's going to happen is that when the next day closes, the moving average is going to move over one. And then the next day comes, it's going to move over again. And the next day comes, it's going to move over again. So it's constantly moving, and that's why it's called the moving average. And let me delete this here. And now you could see that this moving average, this is really smooth. This is a smooth line. And that's because the moving average, what it does is it helps to filter out the noise. It helps to filter out the random noise from big spikes and big drops in price action in order to smooth it out and create a nice smooth line that shows the average value. Now, most traders like to plot multiple moving average indicators on their charts with different time periods to help them out with their trades. So let's do that right now. Here what we'll do is we'll go up to indicators, right? And we already have the 50-day, so we'll just type in 2 more moving average. Here's one, and then here is the third one. And we'll change these. We'll change this one to the 100-day, and we'll put this one as, you know what we'll do? I like to put the smallest ones as red. So I put the 50-day as red, and then I put the 100-day as yellow, and then I put the 200-day or 200 period moving average as green. So now we have this up here. And the reason I chose the 50, 100, and 200 day moving averages is because these are three very commonly used moving averages. The 10 and the 20 period are also really commonly used. And remember what I said about a lot of people using the MA and turning into a self-fulfilling prophecy? So you want to stick to the popular periods when using this indicator. So let's go into the use cases. The first use case is to identify trends and to confirm reversals. If the price is above the moving average, then that's considered an uptrend. And you could see that right here. The price is well above all of the moving averages. So yeah, if the price is above the moving average, then that's considered an uptrend. So you can see the price is above the moving averages, like right here, it goes above it, it just stays above it, and until right here where it falls below the 50-day and then falls below the 100-day, and then it rises back again, and here's a nice uptrend all the way. You know, it falls a little bit underneath the 50-day, but we'll discuss that in a second, but it really doesn't fall back underneath the averages all the way until over here, which is where it falls below the 100-day average. So yeah, if the price is above the moving average, then that's considered an uptrend. And if the price is below the moving average line, then that's considered a downtrend. And when the price breaks through the moving average, that's when the trend reversal takes place. And now, depending on whether the coin is in an uptrend, which is also known as a bullish trend, or a downtrend, which is also known as a bearish trend, that will guide your decision on what you want to do with your trade. So what does all that mean? Well, if the price is above the moving average, it's probably an uptrend. So where does the price go above the moving averages? Right here. Here's an example of where the price moved above the moving averages. First, it moved above the 50-day, and then it moved above the 100-day, and then it moved above the 200-day. So now it's above all three moving averages, and this indicates a strong bullish upward movement, upward trend. So it goes right there, and then you could see it continues to go up, and it does cross over the 50-day a couple times, and then it crosses over the 100-day, you know, right here, just really, really fast, and then it goes back up, and then it crosses over again, and then almost crosses over the 200-day, but it doesn't quite cross over the 200-day, and then it comes up, and it continues to come up. Basically, you know, sometimes it crosses over the 50 and sometimes it crosses over the 100, but it doesn't cross over the 200-day all the way up until right here. And then this now indicates a very strong downward trending bearish market that's about to happen. And then what you could do is you could look right here and you could see, man, it just went really, really down, and this is a good time to start shorting the market is right here. And so it goes down and then it comes back up, and it crosses over the 50, and then it almost comes over to the 100, but it doesn't quite, you know, cross it too much, and then it comes back down. Well, what happens is that all of this occurs, but then finally it crosses over the 200-day, and now this really should have signaled a strong bullish uptrend, but unfortunately a lot of negative news happened, and it just went back down underneath, and it stayed underneath for 1, 2, 3, 4 days, about 5 days, until it crossed back on top. And this right now, I switched to the hourly chart, but let's go switch to the daily chart, because the daily chart is actually, I find the daily chart just more accurate. I like to use it on the daily chart a lot more. So if we look at the daily chart, let's just look at what we just looked at, okay? Here's the daily chart, and here we could see the price crosses over, and now the price is on top of the different moving averages. And the same thing happens. It goes up and up, crosses over the 50-day, just crosses over the 100-day, but it never really crosses over the 200-day. So you would continue to stay in this upward trend all the way up until really down here. So if you're looking at this graph as a whole and using the moving averages, I guess you could say that we started the upward trend, you know, when it went on top of all of the moving averages, which looked like it's somewhere around here is where it broke free, right? And so it broke through, and now it's above the 200-day, the 100-day, and the 50, and it's just on top. And now you don't really want to sell until it starts breaking. And we'll go over the sentiment of the 50-day, 100-day, and the 200-day and what they all mean in a minute. But you could see right here, you would keep your order if, say, you bought it right over here when it passed all of them, you would keep it all the way up and then you really wouldn't sell until maybe down here when it dropped below the 100. But as you can see, you know, sometimes it just goes right back up and back into another uptrend, and that's why you need to use more than just the moving averages and also more than just the price crossover in your analysis. But if you do pay attention to this, you could see some patterns forming. Like, check this out. This happens right around the 100 day, and then it comes back up. It slices through the 50 day, but right around the 100 day, it again finds some support, and then it comes back up. And then right around the 50 day, it finds support, and then it comes back up. And then right around the 50 day, it finds support, and then it slices through the 50 day, and then it finds a little bit of support on the 100 day, but then it slices through the 100 day, and then it went all the way down below the 200 day. And so as you just saw, the price, it likes to, you know, use these levels as support and resistance. So let's go back even further and just like scroll through and just check and see when this happens. So we bust through right here, and then we come back down and bounce off the 50 day a little bit, and then we come back down, bounce off the 100 day, and then we come back up, come back down, bounce off the 50 day. And obviously we're not bouncing directly off of it. This is range. This is like a range. It's not just the direct exact number that you're looking at, but it gives a general sense of where things are. And it just like kept on bouncing off that 50 day over and over and over again right here. Comes back up, bounces off the 100 day, bounces off the 50 day, comes up, and you know, there's not much that you could see right here. So you could see like sometimes it works, sometimes it doesn't. This is just one of those indicators, but it's still a pretty good indicator in my opinion. Bounces off the 50 day, goes up, 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 up. The lowest price bounced off the 100 day right here. Up, 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 up. The lowest price bounced off the 50 day right here. Up, 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 up. Lowest price bounced off the 100 day right here. And then the actual price started bouncing off the 100 day a little bit right here. And this just went right past it, but it found some consolidation around it. And that went up and continued to go up until it finally fell. And then you could see once again 100 day, and then 100 day, and then up, and then a 50 day bounce. And that's why people like to use it as support and resistance levels, or at least the zones that they're at as support and resistance levels. So as you just saw, a lot of times the price, it'll bounce off the moving average and it'll have a really hard time crossing it. And many times, just like regular support and resistance levels, when the price breaks through, the previous resistance becomes the new support, or the previous support becomes the new resistance. So let's find out some examples of that. I mean, you could see right here, it broke through the 50 day, found support on the 100 day, but then it had resistance, you know, on the 50 day, and then support, and then it finally broke through the 50 day right here. You can see like here, the 100 day. The 100 day was the support, right? And so it bounced off the support at the 100 day a few times, 1, 2, 3 times, came up, but then it broke through the 100 day support, and then the support became the resistance. So now it bounced off the 100 day right here as a resistance, and then bounced off the 100 day as the resistance, and then eventually went through the 100 day. And so I don't know if I'd necessarily use them as strict support and resistance levels, but if you know, put these together with other technical indicators, then it could give you a much better picture. So I just moved back up to the daily chart because it's a little bit easier to see and to understand what I'm about to say. So generally speaking, the 50 day, all right, that's a confidence indicator, and that's a good period for identifying the trends in the price. So basically, as long as the price remains above the 50 day, that usually means that the sentiment is pretty positive and that it's in a bullish trend upward. And you can see this was all above the 50 day right here. And then if it breaks the 50 day, that usually means caution. Okay, so that's usually like the sentiment isn't really as high. Something might have happened, whether it be FUD or simply people taking profits, but the price fell below the 50 day and the coin might be starting a bearish trend. But obviously, you know, it doesn't always work out like that just because it crosses over. So I don't really put too much weight when it crosses over the 50. I usually just think of it as like a normal healthy correction. The 100 day or the 100 period might be a good or a better indicator to check for support, because sometimes the price will simply just sell off, but then it'll bounce off the 100, and then it'll sell off and it'll bounce off the 100 if it's in a nice, you know, uptrend. And this might happen a couple times, and it's pretty much a normal healthy thing that tends to happen, where it breaks through the 50 day and then finds support on the 100 day and then comes back up. And this is when there is a normal uptrend in the price. However, if it breaks through the 100 day, sometimes that could spell trouble, and that the 200-day is really where the next support's going to be at. So that's definitely something to keep an eye on. But like I said, you need to use, these support levels, the moving average support levels, along with the actual support levels. Like, right here there was a support, and right here was a support. And let's go through like an example if you were to just use the moving averages as support and resistance. So if you think how you use a regular support level, right, what do? Well, you place your buy order at the support and you place your stop limit order a little bit underneath of it. This is in case the price drops down and it doesn't bounce off of the support. And so some people like to do this with their moving averages, where if the price, say, moves above a moving average, say the 100-day moving average, then you buy when the price moves around the moving average. So let's say it's down here and it moves above, so it comes back down and then it moves back up. So then you're like, okay, well, it came back above it, so I'll buy it right here, and then I'll just set my stop limit order a little bit underneath of it. And then that way it looks like it's going to be a bullish sentiment because it crossed above the 100-day. But if it's not, if it's just a false signal, then my stop loss is right here, right underneath of it. So if it comes back down, I'm not going to lose that much. And you could also use the moving average as a trailing stop loss. So in this scenario, you would buy the price over the moving average, so it'll go down and then it'll come up, and then you'll say, okay, I'm going to buy it right here because it moved above the moving average, and that signals a bullish uptrend trend or a bullish upward trend. And then you would follow the chart and you just follow it as it moves, every hour or every day or whatever time period you want. And you just simply wait until the price crosses underneath the moving average again, and then you'd sell. So in this scenario, you would buy right here at around 2266, and then it would come up and then it would come down, and it actually wouldn't close. You want to wait until it closes underneath the moving average. So it didn't actually close right here. So you would come back up, and then you're using the 100-day. So you would get out like right here when it closed underneath the 100-day. And if you did that, then you would have rode it from around, what did we say, 2,266, 2266, and you would have rode it, for an $8,000 to $9,000 gain right here. However, even when the price does end up going below the moving average, that doesn't always guarantee that the price will continue to go down. All it means is that at the moment, the price is no longer in an upward trend. So like right here at this moment, like the price is no longer in an upward trend because it moved and it crossed over the 100-day moving average. And the other thing is, like, look, you could see right here, if you were to have done that, you would have missed out on all of this. You would have sold it at $11,000, but it went all the way up to 19, 20K. So there has to be a better way, and there is a much better way. And I think that the better way to use the moving average is by using what's known as the moving average crossover. So instead of waiting for the price to cross over, you're actually waiting for the averages to cross over one another. So if you're going to use the crossover strategy, there's actually an indicator that tells you that. So let's go up to indicators, type in MA, and you can see MA cross. And we'll just get rid of the other moving averages. So here's the MA cross, and we will bring these up a little bit and highlight the crosses. So here you can see there are two lines here, and the MA cross, if you pay attention right here, it's 9 and 26. So I'm in the daily chart and it's looking at the 9-day and the 26-day. And if you put it to, let's say, the 4-hour chart, it'll be 9 4-hour brackets. So that would be 9 of these, and then it would be 26 of these. And those are the two different time frames that these things are recording. And what this crossover does, this indicates a change in the direction of the coin. So if a short period moving average, for instance, the 9-day, so let's move this back over to the daily chart. If the 9-day crosses above the longer moving average, so the 9-day is in red and the 26-day is in green. So if it crosses above the moving average, that's an indicator to buy. When a shorter period moving average crosses to underneath a longer period moving average, then that's an indication to sell. So here it is going underneath the longer period average. So this would be an indication to sell. And why is that? Well, The shorter time frames represents the more immediate price action of the coin. You could see it's hugging the coin price a little bit more than this one is, than the longer time frame is. The longer the time frame is, the longer periods it has to account for, and the more it lags behind. But the shorter the time frame, the shorter the period, the closer it will be to the actual price. And what you could do is you could think of the short time frame as like a rabbit, and the rabbit, it follows the price really, really closely, right? If the price turns bearish, but then it starts to turn around and move up, the shorter moving average, which is the rabbit in this case, will catch that first. So here it is. It turns bearish, but then it starts to move up. And what happens is this red line right here, the short moving average, starts to move up right here, while the green is still lagging behind and it's still falling, and it doesn't start to move up until around here. So you could think of short moving averages, like short time spans, like the 9 or the 10 or the 21 as pretty close and hugging, and it's like a rabbit. And then you could think of the longer ones, you know, like the 26 or the 50 or the 100 or the 200 day or the 200 period moving averages. You could think of those as turtles, like tortoises, and it's like the rabbit and the hare. So the rabbit's always following very closely. And then what happens is the price moves, and the rabbit will turn with the price and tell the turtle. However, the turtle takes a long time to turn around, so it lags behind, and then finally it starts to turn around. But the rabbit told him right here. So eventually what happens if the price, you know, say it goes down, but then it starts to come up and it continues to move up, eventually the shorter moving average, or the rabbit that follows closely to the price, will cross the longer moving average, which is still in the process of turning around. And this indicates that the coin is now bullish. And the opposite is true as well. So if the long term says that the price is bullish, but then the short-term moving average drops underneath of it, that says, hey, the price is falling. So you could see right here is a good example of that. So right here, the short-term crosses from on top to underneath the long-term, and you know, you could see it fell down, but the long-term was still moving really slowly, and then finally it started to turn around and come back down with the price. So this one started all the way back, you know, all the way back here, really. And you know, this works pretty good. And if we go into the 4-hour chart, you could see, if I could find it right now, here it is, that it's pretty good, because like right here it says, okay, the price crossed from on top to underneath, so that signaled a bearish trend, and that was at, you know, almost at the top, 18,000. However, the same thing happened right here, and it happened right here as well. So I would not only wait a little bit before making up my final decision, but also use a ton of other indicators as well. And I just zoomed in right here on the 4-hour to a particular area, because if it's really choppy, you know, like this is right here, sometimes using the strategy isn't really that good. And this is why. Okay, let's say that you're using the crossover strategy. So it crosses the short area, rabbit crosses over the long area, or the long period. And that's supposed to be a bullish signal, right? It's supposed to be a bullish signal up until it crosses over again, the next crossover. Well, what happens? The next crossover happened right here. So you would probably lose money on this trade unless you got in at the very second that it happened, which no one really does, and then you set a stop limit order for the same price. So you'd probably end up losing money, and you'd get stopped out right here. So, and then if you did it again where you relied only on the crossover from the short one to cross on top of the long one, right here you'd put your buy order in. But what would happen is, oh no, it went down and it crossed over again right here. And even if you missed this one, you'd probably hit this one, which means that it's a bearish trend, and then you would sell out right here, so you'd end up losing some money on this trade. And all right, so now I want to talk about the simple versus the exponential moving average. The simple average is abbreviated the SMA, and the exponential moving average is abbreviated the EMA. And like I explained before, let's just say that you want the 10-day simple moving average, or 10-day SMA. So you can do that simply by going up here and then, you know, clicking MA and moving average, and then just making this moving average 10. So here it is at 10, and we'll put the style, we'll make it orange, and we'll take out the cross. So now you have your 10-day moving average, right? And like I said before, that would be created by adding up the closing prices of the last 10 days and then dividing that by the number 10, right? So this gives the same weight to each day. And then every time a new period is available, if I zoom in, the old period gets dropped and it moves, and then it becomes here, and then it moves, and then these 10 get weighted, and then it moves a day, and then these 10 get weighted. And what this does is it keeps the average at the same number of periods. It's always going to be 10-day periods if you're using the 10-day moving average. And as you also saw before, the longer the SMA period, the more it lags and the slower it is to react to the most recent price movement. This 200 is a lot slower than this 10-day. And what happens is, since equal weight is given to every single period in the calculation, the SMA might be slower to respond to rapid price changes that would prove to be important. So if there's a really big spike downwards, the SMA might lag a little bit behind it. And that's why people tend to use the SMA more as support and resistance levels, along with defining trends for longer term trades. Now, there is another moving average called the exponential moving average, abbreviated EMA, as you could see right here. This is the exponential moving average. And what this does is this gives a lot more weight to recent periods and therefore gives more emphasis to what traders are doing at the moment. So this means that the EMA, if you're doing faster trades, you might want to use the EMA. So if you go to your indicators and type in EMA, you'll see moving average exponential, and you'll also see it has the moving average exponential cross underneath that as well if you want to do that. We'll have the moving average exponential, and then we'll just have the regular moving average, okay? And we'll have those for the same time period. So let's put, 50 as the time period for both the standard simple moving average along with the exponential moving average. So the exponential moving average will be this yellow line, and then we'll have the 50 period regular moving average or simple moving average be this green line right here. So what happens with the exponential moving average is that the first day is weighted the most. So this is how you could think of it. You could think of it as the first day being weighed in as 1. And I'll just do this. Day 1 equals 1. And then you could think of the previous day equals 1/2. And then day before that equals 1/3. And then so forth, and so on and so forth, right? And the equation is really, really complicated, but ultimately it means that the exponential moving average, it responds faster to price action by distributing a lot more weight to recent periods and less weight to older periods. So remember, the EMA, the exponential one, is in the yellow, and the simple moving average is in green. And you can see the yellow, they're the same period. They're both 50, but the yellow hugs it a little bit tighter. And what this means is that if there's a really, big price change because of the news or something like that happening with a coin, then the exponential moving average will be closer to the price than the simple moving average. And that's good and that's bad. It depends on your trading strategy and, how long you're trying to have your trades for. If you're a day trader and you want to day trade and you want to trade every, couple minutes or every couple hours, then the EMA is probably your better bet. And this is really good if the market is moving really, really fast. And you'd probably use the SMA or the simple moving average if you plan on swing trading a coin, over a longer period of time. And this is because the EMA, the exponential moving average, it might actually be too sensitive and give false signals. So whichever one you use is really up to your personal trading strategy. And we'll touch on that right now. So apart from deciding whether to use the simple moving average, the SMA, or the exponential moving average, which is the EMA, you also need to decide on what time periods you will use. So what time period will you use? Well, the shorter time period you use, the closer it will resemble the price action. And you've probably recognized this by now, that the shorter moving averages, it generates signals faster than the longer time frames. So short time frames on moving averages, they're good for very quick day trading. So that means that you're going to use the 9, the 21, the 55, but you probably wouldn't really care to use the 100 or the 200 if you're doing simple, quick day trades. And likewise, if you're doing longer swing trades, you're probably not really going to care what the 9 moving averages, the 9 period moving averages or the 21 moving period averages. Like, you'd look more at the 50, the 100, and the 200 if you're doing longer swing trades. And that's because the longer time frames, they take into account a lot more data. So it lags a little bit more behind, but it generally gives you a lot more confidence in the indicator. Like, personally, I get a lot more confidence in my trade when I base it off the 100-day SMA compared to, say, a 10-day SMA. And this is why people plot multiple moving averages on a graph. You could set a 50-day, a 100-day, and a 200-day all on the same graph, just like what we did before. And this gives you a better picture of the direction of the coin. And the moving averages can be used when it comes to whatever time frame period you're using. It could be used whichever one you want. I feel like most people use it between the 1 day and the 4 hour, and then sometimes the 1 hour. Unless you're doing day trading with the exponential moving average, then you could go all the way down to 5 minutes, and then you could set it for really close and shorter periods. And this is not something that I really do. I'm not a day trader so much, so I can't go into too much detail on that. But there are a lot of other people and videos that do day trading like really, really well. So I might look into that if that's something that piques your interest. Personally, for long-term trends, people like to do, 50, 100, 200 period moving average, and this is what I tend to do. For short-term trends, they plot anywhere between 8 and 55. And like I just mentioned before, someone who I follow who's a very short-term trader sometimes does the 9, 13, 21, and 55 period moving average. So those are all fairly short. You're not seeing the 100 or the 200 period in the shorter time frames. All right, I think that's pretty much it for the moving averages. This was a long video, and technical indicators, technical analysis, it's tough. I'm not gonna lie. There's a lot to learn, and you just got to keep on doing it over and over and over and over again in order to figure it out. But let's just go over the recap of what we learned about the moving averages. First thing, the moving average. What is it? The moving average is a lagging indicator that is a smooth line of the average price of the coin over a given period of time. There's 2 main types of moving averages. There are a lot more, but for the purpose of this video and what you need to know right now, there is the simple moving average and there is the exponential moving average. The EMA, the exponential moving average, reacts more quickly to recent price action than the simple moving average. So that means that the EMA is better for quicker trades, but it could also give some false signals, so you need to be watching out for that. The third thing is that moving averages are really good at, or can be good at, identifying trends when they're about to happen or a little bit right after they happen. And they can be great indicators to use during trending markets. So that means if there's a bullish or a bearish trend in the market, but they prove pretty difficult to use when in a market that is sideways or range bound or in a tight range, because there's a lot of false signals that happen when using the moving averages when it's in that scenario. Fourth is that you need to use different length moving averages for your specific trading style. And then finally, just like every indicator, you should use multiple indicators along with the moving average to help you decide if your trade is good or not and give you more confidence in your decision. And that's pretty much it. Look, I know that this might be confusing or a little difficult to grasp. It really is like learning a new language. And the way to get good at it is to try it and just do it over and over and over again. But like everything else, if you want to become really good at something, practice makes perfect. So you gotta just keep on doing it and getting it down to start to understand everything. And that's really the best way if you want to become a trader. And that's going to do it for this video. If this video was helpful, be sure to smash up the likes, give it a thumbs up, subscribe if you want more. And if this was just way too overwhelming and you just want a beginner's approach and you just want to learn everything step by step by step, then I do have a free course in the description for you if you're new to all of this stuff and you want to get it better handled. So you could check that out if you want a little bit more clarity into everything, if this is all way too confusing for you. And other than that, let's get to the moon together. I'll see you in the next video. Peace out. Bye.